Measuring a nation's income through expenditure method. Factor income earned by factors of production is spent in the form of expenditure on purchase of goods and services produced by firms. Gross domestic product at market price is sum total of final expenditure incurred by household, business, firms, government and foreigners. Total spending is classified into four components: consumption, investment, government purchase, net exports. Consumption is total spending by households on goods and services, which may be called private final consumption expenditure. Private final consumption expenditure refers to expenditure incurred by households and non-profit institutions serving household on all type of consumer goods, that is durable except houses, semi-durable goods and services. Special case for renters, consumption includes rent payments. For homeowners, consumption includes the imputed rental value of the house, but not the purchase price or mortgage payment. PFC includes expenditure incurred by residents of the country, whether in the domestic territory or abroad. Therefore, any expenditure incurred by residents during their foreign tour travels will be added in PFC. However, any expenditure incurred by non-residents and foreigner visitors in the domestic market will be deducted from PFC. The expenditure incurred on purchase or construction of owner-occupied houses is not treated as durable consumption, whereas other costly consumer durables like cars, air conditioners, washing machines are included in private final consumption expenditure. Government purchase is all spending on goods and services purchased by the government at federal, state and local levels, but excludes transfer payments like social benefits. Government final consumption expenditure refer to the expenditure incurred by general government on various administrative services like defense, law and order, education. It also includes government expenditure on goods and services to fulfill social welfare. Investment is total spending on goods that will be used in the future to produce more goods. It also refers as gross domestic capital formation. It includes spending on capital equipments, that is machines and tools, structures like factories, office buildings, houses, and inventories like goods produced but not yet sold. Investment doesn't mean the purchase of financial assets like stock and bonds. From the wheat, flour and bread example, one can see the video of measuring nation's income through output method. One can go through the example and then can see that other than the wheat, the miller required building, specialized type of machinery, electricity power, pens, pencils, insurance coverage and other non-durable items. Figure for this amount of wear and tear on plant and equipment for a given period is provided by the amount that the firm charged in their books as depreciation expenses for this period. Gross and net fixed investment spending are determined for each and every industry, and the total for all industries combined are the gross and fixed investment for the economy as a whole. Sum of C, G and I would give the total spending on final product. But this is not always true, as some goods produced during this period remain unsold during the period. If you go back to same example, net investment of the miller is the sum of the amount of goods that miller purchased from other firms like wheat and flour making machines that was not used up, the cost of producing other goods during the time period, and the amount of goods produced like flour that were not sold to other firms during the time period. Net exports refer to the difference between export and imports of a country during a period of 1 year. Exports refer to expenditure by foreigners on purchase of domestic products. The exported goods have been produced within the country's domestic territory, so they are included in output of an economy. Import is the expenditure by residents on for foreign products. Imports are deducted to obtain domestic products as they are not produced within the domestic territory. Instead of treating exports and imports separately, the difference between the two is taken and is termed as net expenditure. Any increase in stock of consumer goods with households is excluded from inventory investment as it is assumed that such goods are consumed the moment they are purchased. Purchase of shares and debentures is not included as it is simply a transfer of purchasing power as there is no addition to flow of goods and services. This is a precaution which should be taken care while measuring national income through. The other precautions are purchase of second-hand goods like old house or old machinery is also not included as such goods have been already included in the year of original purchase. Expenditure on intermediate goods will not be included in the national income as it is already included in the value of final expenditure. If it is included again, it will lead to double counting of expenditure. Transfer payments are not included as such payments are not connected with any productive activity and there is no value addition. Purchase of second-hand goods will not be included as such expenditure has already been included when they were originally purchased. Such goods do not affect the current flow of goods and services. However, any commission or brokerage on such goods is included. Purchase of financial assets, shares, debenture, bonds, etc. will not be included as such transactions do not contribute to current flow of goods and services. These financial assets are mere paper claims and involves a change of title only. Expenditure on on-account production like production of self-consumption, imputed value of owner-occupied houses, free services from general government, and private non-profit institutions serving household will be included in the national income since they are productive services. Thank you for watching the video.